Welcome to the weekly update, where I'll go over the action in the market for the week of March 31st through April 4th, and we'll see how things look for the week of April 7th through the 11th. Pretty negative week, more negative than we've seen in quite some time, probably going back to the COVID crash. But both Thursday and Friday were severe down days. We're looking quite negative right now, but possibly a little too negative. We're getting some extreme negative readings, which can often come together and produce a potential bounce, but we see no confirmation of that yet. We'll just have to see how things play out. And this has to do with uncertainty around the tariffs. What's going to happen with the economy? What's going to happen with these relations between different companies? And is what Trump is trying to do, is that even going to work? Is it too crazy? Is there really some method behind all of this? There's a lot of variables right now, and it's got the market pretty unsettled for the time being. Okay, before I get into the video, please know that I do post videos every day where I provide commentary and analysis. Now, the daily videos that I post on YouTube and Rumble, they're delayed. They're not available until the market closes for that particular day. If you want to have access to them immediately, right when they're available, and that's usually over the weekend with the weekly videos like this one, I'm going to be starting a program here pretty soon, probably through Patreon, where for $20 a month, you can have immediate access to just the videos. You like the videos, but you don't want to necessarily be involved in the full-blown program that I have, and this is a way for you to have those available to you. Also, I've been in the process of rolling out daily and weekly newsletters. Those might be included as part of the video service through Patreon. If you're a full member in the program, those will be included. And I've had members now that have been reading through that and giving me feedback about that before I officially launch them. But they're just short, and they're designed because I know the videos that I do are longer, and you don't have time to watch the videos all the time. Well, just reading through the daily newsletter in a few minutes, that can give you an idea of what's really going on, and then let you know, okay, maybe I should watch the daily video. And the same thing with the weekly newsletter as well. There is a PDF below every video that I post on YouTube and Rumble. There's a link in the description where you can download and see what I'm looking at right now. Then I do have a full-blown program. It's free for right now. Feel free to go check that out. Here's the link. There's also a link right at the very top of the description below this video. And it's not going to be free for much longer. So if you want to, go see if it meets any kind of a need that you might have. I'm an educator, and that's the whole approach that I use with this entire program. I don't tell people what to do. I'm trying to teach the skills for you to develop your own way of thinking called critical thinking, and you can reach your own decisions that way. That's my whole approach, which is different than most people out there. Most people want to be told what to do and then not necessarily take the time to learn how to do it. I take a whole different approach with that. Also, on the YouTube community tab, I update pivot points. These can be very useful. I really follow the intraday pivot points, and I update that chart every day. There's also another chart which has pivot points that last for the whole month, but I update the chart each day with that particular day's candle, whether it was up or down. And you'd be surprised at how accurate these can be. And a lot of the automatic algorithmic trading that takes place by computers instead of by real people, they program these pivot points in there. And when we hit one of those levels, it's either buy or sell. And it's amazing how that will provide either support or resistance. And they're really quite accurate. And that's freely available on the YouTube community tab. I do have a private Facebook group. It's not really active, not a lot of members, but if you are a member of Facebook and you want to join, feel free. You can send me a message. I post every time I put up a video. If you want to have some back and forth, that certainly can happen. And I really watch comments. If you are posting garbage not you, if I see garbage comments, they're deleted immediately. These bots that go out there, and they've got all these, especially on Rumble, they must have gone through another recent webinar or something where they're telling people how they're social media experts, and they try to get you, it's a scam. They try to get you to buy into this software that's either really bad or doesn't even exist. And I provide an email address in every video, and they tell me about how great my videos are. Well, if they had actually watched the videos, they would see the email address, but they don't watch the videos. So they're starting with a lie right off the bat. Why would I believe anything they have to say after that? So I'm really careful about that. Now, if you want to have an honest back and forth, you agree, you disagree, you like, you don't like, that's fine. That's back and forth. That's what the comments are designed to do. But the garbage ones, they get deleted really quick. And I do post videos on YouTube and Rumble as well. Okay, let's go back and talk about this week's session. For the week, we were down 9.08%, and pretty much all of that came on Thursday and Friday. Wednesday, we were up on the week and we were looking a little bit better. And then everything came down quickly in Thursday and Friday session. We were well above average with volume, especially when we were coming down. We just saw volume really shoot up. People were just freaking out. And we are negative for the most part with a lot of our charts. There are some positive things that we'll go through and point out. I'll also try to compare them to the daily charts as we're standing right now. We will get a read on inflation this week. We'll have CPI and PPI coming out later. Interest rates, we actually fell under 10% with the with the 10-year yield under 4%. And that it's more of a flight to safety. People are getting out of stocks and getting into bonds when they freak out like this. But at some point, interest rates may drop enough where people go, wait a minute, stocks might look good again because interest rates are going down. That might help companies' earnings look better because they're not paying as much in interest. Let's go in and buy some stocks. So it kind of goes back and forth like that. And then it's all geopolitical right now. It's the tariffs that Trump has been announcing and then the world's reaction to it. There's a method to the whole thing, but it's a lot of uncertainty right now, and everybody's trying to figure out what's going to happen, but nobody really knows at this point. We're going to be coming into earnings season. The banks are going to be reporting here pretty soon, and that could be pretty influential as well. There's also this debate going on back and forth. Are we going to go into a recession? Are we not? The charts are kind of leaning a little bit more that way, but there's other charts that are still suggesting that things are okay for right now. I'm watching some different bond spreads, different ratios of bonds between shorter term and longer term bonds. And those are actually showing more deflationary signals right now. Now, that could always switch back. The CRB index, which are commodities, it's been going up, but it got crushed on Thursday and Friday, just like everything else. And then Fed Chair Powell came out on Friday after the employment report came out, and that was a bit disappointing. The headline numbers were strong, but they revised down previous months' numbers. And then Chairperson Powell comes out and says, well, yeah, there might be some problems with these tariffs, and we're not going to do anything about it right now. So there's really no way to lean back on the Fed to say, are they going to come in and help things? So we'll just see how things work out and how much more damage, if any, is still left to be done. But this is part of capitalism. This is how the markets operate. We are negative with our trend, and it's now confirmed. We've crossed above 20. The red line is above the green line, so it's a confirmed strengthening negative trend. All right, so here are some bullet points here. The week marked a dramatic turndown in stocks in the U.S., driven by escalating trade tensions and fears of a recession. Trump's announcement of Liberation Day, which kind of turned into Obliteration Day, at least on Thursday and Friday sessions, on imports triggered the worst single day sell-off. Actually, Thursday and Friday were pretty bad. Friday was even worse than Thursday. Since early 2020, that's when we had the COVID crash. And then the range of these tariffs go from 10% to as high as 54%, depending on the reciprocal duties or tariffs the countries are putting on the U.S., and non-monetary measures imposed by other nations. This sparked fears of stagflation, where we have super high inflation and little to no growth in the economy. And this could really cause a lot of global trade disruptions. But people don't really know, or countries don't know, let alone us that follow this. We don't really know what the ramifications are going to be. It could be a total failure. It could be a screaming success. So we're just kind of following it as things unfold. China then retaliated. This is what caused the big drawdown on Friday. They retaliated with matching tariffs of 34% on all U.S. imports. But you look at it and we don't buy or we don't sell all that much stuff to China. We just buy a lot of stuff from them. So is that really going to have much of an impact? Okay, the Dow dropped 3,200 points. I don't focus on the Dow and I don't focus on points. I focus on percentage. It was down 7.9%, entering correction territory, which means it's now down over 10% from its all-time or recent peak anyway. The NASDAQ was down 10% this week, and it's actually in bear market territory. It's down over 20% from its recent peak, and the S&P, it's getting close. We're about 17 to 18% since the all-time high set in February, where we declined 9.1% for the week. Not a really positive week unless you were short on the market. Tech stocks, these are growth areas. They were hit hardest with names like Apple, Nvidia, Meta, Facebook. They all had double digit losses if you go from Friday to Friday. And the tech sector, the other growth, the main part of the growth area, it was the weakest. It declined 11.4%. Energy was down 15%. Usually that's more of a defensive area. And the financials, which we need that to be strong. This is what really started to fall apart before the great financial crisis. Now, one day is not a trend. Well, we're still in an uptrend with the financials. We're still in an uptrend with all these different sectors. They've just been seeing a lot of recent weakness. And then slowdown fears manifested in dropping oil prices. Yeah, now that could actually be kind of cool. Gas prices going down. We're into the lower 60s now. And we also saw the 10-year yield drop down below 4%. And that could be seen as positive as well. But the VIX, man, we came in at 45. Now we get concerned when the VIX goes above 20. We get really concerned when it goes above 30, and that's where it was after Thursday. Now we're even more concerned because we're in the mid 40s now. That's just showing massive fear in the market right now. Okay, so the Dow was down 7.9% for the week. The Nasdaq was down 10%, just flat, nice round number there. The S&P was down 9.1%, and small caps, which had already been struggling and have been struggling for 2025, they were down 9.7%. Okay, this is what the market is fearing right here. And I've been showing this chart for almost 2 years now as we've been coming down with inflation. We're still in this light blue line area where inflation is supposed to be coming down. What people are freaking out about is look at what happened back in the 70s when things really started to go up. They're afraid of some environment like what we saw before developing again. Now, we don't know if it's really going to play out that way, but there is a lot of concern that it might turn into something like that. Now, with the drop in the 10-year yield, we're actually underneath that 4.02% level. And according to the RenMac research, when we're under that level, this helps corporate profits to go up because they're not paying as much for interest now, and it can go more towards the bottom line. So if we can stay under that 4.02% level, which may last a day, it may go up again on Monday, who knows? But the longer we can stay below that, the more positive it could be for corporate earnings. All right, and this was updated because we had the employment report come out on Friday. We came in here with a slighter, it went down a little bit, slightly lower. These are people that are unemployed over 6 months, long-term unemployed, and it's actually been coming down. We're going to be keeping a real close eye on the employment numbers to see, are they getting better? Are they getting worse? Or are they staying the same? Because if that really starts to fall apart, that's really going to throw us into more of them. We might go into a recession category. All right, then looking at this now over here on the right-hand side, 2025, they're calling it here, JP Morgan anyway, that these are tax hikes because of the tariffs. And you notice other times, 1941, there's something kind of major happened then. We ended up being attacked by Japan, and then we got into World War II. Okay, so they raised taxes at that point. 1951 happened to be this little thing called the Korean War going on right about that time. 1968, the other time that the U.S. almost fell apart, we had RFK Sr. assassinated, MLK Jr. assassinated, the Tet Offensive in Vietnam. The only good thing that happened that year was Apollo 8 went out to the moon, went around it 10 times, and came back. The whole year, I was 5 years old at that time, and I don't really remember these things. I remember the Christmas Eve moon thing, but you look back on history, and there was a lot of problems in the country at about that time. Shortly after this is when Lyndon Johnson said, no, I will not run for re-election. Then after that, Nixon was elected. And then 1982, there were some bad things going on then too. Ronald Reagan was newly into his term. He survived an assassination attempt and he was implementing a lot of new things. And there was a lot of resistance to that. And folks saying, you don't know what you're doing. This guy's a buffoon. Well, after giving it some time, this really worked out well. And a lot of the prosperity that we saw into the 90s, the whole dot-com boom, that foundation was laid by things that Reagan and then Bush Sr. did in his one term that paved the way. Of course, Clinton takes credit for it because he was president during the 90s, but the foundation really was before that, about 10 years before. And so we'll have to see. We don't know how all this is going to play out. You've got people, no matter what Trump does, they hate him and they just think he's terrible and doing exactly the wrong thing. Even people that like him are like, I hope this works. I mean, but if we want things to change because the path that the US had been on was pretty much unsustainable with the massive debt and just all the problems and the divisiveness that's going on in the US right now, things are going to have to change one way or the other. And so the people decided that they wanted Trump to have another shot at being president, and he's really in there doing what he thinks is best. And we'll just have to see how it works out. It may end up being good, it may end up being bad. We don't know. So anybody who has an opinion at this point just doesn't know because it's too early to tell. Only a bigger picture look is really going to give some honest, objective analysis of what's happening. Okay, now this is still looking okay for right now. We get this chart right after we get the employment report. We're under the red line. And quite often, what happens when we drop under the red line, that's when we go into a recession. That's what's happened before. Well, we dropped down below it, but we didn't go into a recession this time. And this red line is starting to go back up. So if we can get back above the red line, that would be even more positive. If we start to turn and come down and then go into a recession, that's going to be more negative. Then looking at profit margins here by JP Morgan, they're actually projecting them going up on a quarterly basis. That could be positive. And then when not so much on YouTube or Rumble, but within the program I have, I do a pre-market open video and I look at an index called the MSCI World Index. Well, that gives us kind of a good idea what's happening because the US hasn't opened yet. And so we're getting a lot of the readings from these other countries, and it gives us a global perspective because 64% of that index is the US. Well, we also can look at France, UK, China, Japan, and this great big other over here. And it gives us an idea of what's happening. And this just shows you the breakdown of that particular index. Then FactSet had a couple of posts. It said the S&P companies are issuing negative earnings per share guidance more than average. And you can see over here on the right-hand side, that's a little bit of a concern. It says 107 companies have issued quarterly earnings guidance. Of those 107, 68 are negative, 39 are positive looking forward. But it's more than the average. It's more than what we've been seeing lately. And that's a bit of a concern. And analysts made larger cuts than average to earnings per share estimates for S&P 500 companies. The takeaway from this, you can see way on the right-hand side, this is going down and the chart is going down. And then we look at this in a bigger picture. This is going down and the chart's also going down. Now the earnings are still positive, but they're not as positive as they have been. So they've been revising them lower, and that's causing a lot of the pressure. About the time we really started to stall out with the S&P was when people are saying, wait a minute, earnings aren't looking as good or as rosy as they were before. They're still positive, but not as positive as they had been. Okay, here's the intraday chart. Things were looking pretty good up until Wednesday. And then this was done on purpose. Right after the close, that's when Trump made the announcement. And he knows about the stock market. He's not silly. I mean, every administration does that. I mean, I remember Clinton, Bush, Obama, and even Trump the first time. I mean, if they had a major announcement to make, it would be on a Friday evening before a 3-day weekend because they know everybody's busy and they're not really paying attention. So those are just little things that happen. But then the announcement came and we really gapped lower. We went all the way down to S3 and closed at the low. Then China came out and said, no, 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 America, we're going to tariff you back. And so we saw an even bigger decline. We went down below S3 all the way down to S4. These are the pivot points that I update, and we know these lines before the market even opens. Now, we don't know S3 or S4. Those aren't put on the chart automatically. I have to calculate those using a pivot point calculator. But these lines that you see here, they're on the chart before that day even happens. And these can be really good at providing support or resistance points. Okay, so all of the indexes were down on the week. This is just the 5 trading days. The NASDAQ and NASDAQ 100 were down the most, and the Dow was down the least. And if you watch the deep dive video where I rank the 6 indexes that we follow, the Dow's coming in first place, and it has a score of 40 out of 100. We have the small caps, they're at 9 right now. I mean, everything is looking bad, but the Dow is at least looking the best of the bad or the least worst. I'm not sure. Okay, then looking at the year to date, all of the indexes are down. The NYSE was holding on to a gain that was taken away, and we're all negative with the NASDAQ and small caps leading things lower. The different sectors, since we had a negative week, energy down 14.79%. Woo! Tech, a growth area, down 11.63%. The financial sector, everything got hammered. Every single sector was down. The one that was down the least are staples, and those are defensive areas. That's toilet paper and toothpaste. Utilities, another defensive area. Real estate, which can be another defensive area. Healthcare, these were down the least, and they got hit. And then discretionary, communication, and tech. Those are the big three growth areas. They all got hit as well. Then I sort them differently over on the right-hand side by their scooter score. This is another scale of 0 to 100, where we have staples still looking the strongest, but they're only coming in at 76. Our really strong sector is in the high 80s or low 90s, or even in the mid 90s. And then utilities, another defensive area, that's looking okay. Where we have way at the bottom, tech coming in at 5. All right. And even discretionary is below 50 at 38.5, communications at 52.5. Nothing is looking all that pro growth right now. And looking at the different sectors, just for the week, we had energy and tech down the most. Financials got hit. We want to keep an eye on that. Where things like, now this is measured a little bit different way, where we had staples, utilities, real estate, healthcare. These are the defensive areas. Now, discretionary did okay. It was up, but that's a growth area. But these other areas that did better, they're more of the rotation that we've been seeing lately, going from growth to value. Now, year to date, we have tech and discretionary down the most, where staples, utilities, healthcare, real estate, these are the more defensive areas, and they've been the areas that are outperforming. Then looking back over the last year, where we're seeing a little bit of improvement here with the financials. Now, this goes over the last year, a little bit of improvement with the communication. We're seeing a bit of an improvement here with healthcare. That's defensive. Staples, XLP, utilities, that's another defensive area. And then we're seeing things like XLK, that's tech, and XLY, that's discretionary, showing some weakness right here. This shows it more in a spreadsheet type format where the green areas are looking a little bit better. And a lot of these are defensive, but some of the growth areas are holding up. Utilities, energy, and let's see, staples and healthcare. Those are defensive. Financials, they're more of a growth area. They go more or less with interest rates in the economy. Communication is a growth area too. The areas that are weak are the red areas, tech and discretionary. The areas that are at least stable for right now, these go along, well, real estate's more defensive, but these tend to go along more with they're cyclical. If the economy's doing better, they go up. If the economy's doing bad, they go down. Okay, then looking at these here, the different indexes, where we still see the S&P holding up. Now, that's because the S&P is not just growth, it's growth and value. So when we're under pressure, we see indexes like the NASDAQ 100, that's growth, and it goes down more. Now, when we're going up, it goes up more. The S&P is more balanced between growth and value, so it's been holding up a little bit better. But the biggest stocks in the S&P 100, that's showing weakness. The NASDAQ 100 showing weakness. We're seeing a bit of an improvement over the last year with the Dow Jones Composite, which is the Dow, the transports, and utilities. And most of that has to do with utilities holding up. And then here's utilities showing some improvement where we have the mid caps, the transports, and the small caps. They're negative now. So we have the S&P still holding up about the best, and even it's almost into bear market territory. And then the S&P 100 and NASDAQ 100, the areas that are showing weakness, mid caps, transports, and small caps. Areas that are somewhat stable right now would be the composite and utilities. Okay, sentiment. First of all, every week we get the Investors Intelligence Survey. These are folks that make recommendations. Should you buy? Should you sell? Should you be in? Should you be out? For 3 weeks now, we've been right around this one level. That's an extreme negative reading. We come in right at one with the latest reading. That's extreme negative. Now, usually we would use this as a contrarian indicator, but we've been down in this area for 3 weeks now. Sentiment coming in at a blistering 4. Okay. We get concerned when it drops below 25 and we're all the way down to 4. I don't know if this thing can even go negative. That'll be interesting. And then this gives you a historical look at this. We get concerned, like I said, when we drop down below 25 and we get in that area, and usually we V bounce out of this. We've just came down here and camped under 25. We little spurt above it for a few days, but now we're getting such a low reading that just shows everybody is bearish. And we tend to use this as a contrarian indicator as well. The active asset managers leaning a little bit more bearish, but not really extreme. And they're coming in with their latest score of 49.37. The VIX shooting to the moon right now, both with the bar chart and the line chart. This is just showing a very big increase in fear. This is also more negative. This is cash to the tech sector. When this is going down, that means tech is outperforming. It goes a little counterintuitive. We're seeing it really spiking up here, going above this red Ichimoku cloud. This is similar to what we saw back in 2022, which was a cyclical bear market. Are we going to be entering something like that again here? The right X bear bull ratio giving a very high reading. That just means folks are more into the bearish mutual funds that benefit when the market goes down than they are the bullish funds. But they get ping ponged back and forth. We have an up day, they jump in the bullish fund. We have a down day, they jump in the bearish fund. And then the next day is just the opposite. And so they end up getting whipsawed back and forth, doing exactly the wrong thing at the wrong time. Okay, another sentiment indicator right down here is showing that we're extreme negative, but this could go lower. But these are significant down times that we had in the market back in 2011 in October. We were able to bounce up out of that. February 2016, December 18th, that was Christmas Eve. We had like a mini crash, and then we were able to bounce up out of that. Then this is March. This is the start of the whole COVID crash, and we're even worse than that now. And then December 2022, things got bad during that time as well. We're getting a very low reading, which could be used as a contrarian indicator, but we need to see confirmation with price. Then this also shows the individual investors coming in 6 weeks now with a very extreme negative reading. This is the chart that I show where they're just camped down here. Usually we come down, we get extreme negative, everybody freaks out, and then we bounce up out of that. They're just camped down here like they are with sentiment. The Ulcer Index, another fear gauge, above the moving average and going up. It's also going up really strong on the daily chart. This is the risk, the spread between risky bonds and not as risky bonds. This is going up, which is causing us some concern, but we're not at levels like this is the COVID crash. This was the great financial crisis. If this continues to go up, yeah, we're going to get nervous, but this just is a way of looking at sentiment in the bond market. Now, a variation of that is this next chart. That's the same chart that we just looked at, but it's flipped upside down. It's inverted to pair up with what the S&P's been doing and what the VIX has been doing to make them all going in the same direction here. And yeah, this is a concern to us, but we've seen it a lot worse than this in the past. So we'll just be keeping an eye on this. If it continues to fall, that is going to be more negative. Then the VIX, and then a 3-month average of the VIX. That just shows that in the shorter term time frame, the VIX is going up more than the 3-month averages. And so we're really seeing this ratio going up as the S&P has been going down. This is not really changing all that much. The equity put call ratio, this is 253 periods. That's a whole year. Usually when we're turning over negative, we're going to see this turn and go up, and it's been just kind of leveling off. It has been declining. We'll see if there's a change in that one. Now, looking at the economy, this is a newer chart. This is the weekly economic index, kind of humming along, going sideways, not really going up, not really going down. Then we have the weekly chart of the national financial conditions. We get nervous if we go above the black line. We're not there. This is what's causing a big freak out amongst a lot of people. The Atlanta Fed GDP now forecast, they're having us down around a -3% for GDP. And if that happens for two consecutive quarters, that means we're in a recession. That's one of the parts of being in a recession. The only problem with that is the folks in Atlanta are negative, but if you ask the people in New York, they're positive. Their Fed is saying, we're going to have growth of 2.6%. So we're seeing a real difference here. So, all right. This is the Atlanta Now, or I can't, the GDP Now from the Atlanta Fed showing that they think we're going to have negative GDP for the first quarter of 2025, which we just finished. All right. This didn't change. This still came in at 0.27. This is the real-time SOM rule recession indicator. When we got nervous is when we came up to this black line. That's a reading of zero point 0.5. And that has been a pretty good indicator of are we going to go into a recession. The only problem is the perma bears love this when we got up to this red line, but we're coming back down. And we've had the same reading for 2 months in a row at 0.27. Usually what happens is we go above the red line and then we keep going up. Yeah, we're coming down now. So this is adding a little bit of ambiguity to are we going to go into a recession? This is another smooth U.S. recession probability, still getting a very low reading here. And this is a quarterly report where we're actually coming down. Usually when we're going up with this, it's the Brave Butters Kelly leading index. This is when we just move into a recession. Well, we didn't do that this time. And now this indicator is actually starting to come down. As far as inflation, we started a new quarter. We'll get CPI and PPI in the upcoming week. So these will be adjusted. As far as the Fed, they're going to meet again on May 7th, and they figure a 66.7% chance that rates are going to be the same as what they are right now. And we're kind of locking more into that. A little bit more people getting into the 25 basis point cut. That's a little more evident when we look at the June meeting. They're thinking that we're going to get a rate cut then, but look at the context. Why would the Fed come in and cut rates? Now, last fall, they cut rates because everything was looking pretty good, and maybe we could still lower interest rates and help the economy go a little bit faster. This could be a rate cut because they're worried about the economy slowing down and possibly going into a recession. The whole context is different. This will change a lot between now and June 18th, but right now, most of the folks think there's going to be a rate cut at that next meeting, and a little bit more conviction developing with that idea. But there's still plenty of time for this to adjust. Keeping an eye on the Fed balance sheet, they've actually decreased the rate that it's going down at their last meeting, but it's still coming down as all the stuff that they bought to try to stimulate the economy during COVID. That stuff is starting to mature and falling off their balance sheet, but slower than it was before. This is the year-over-year change, which just to give us some perspective on that. And this was causing a concern about a week ago. We were starting to spike up with the overnight reverse repurchase agreements, but now it's come back down. So even though the financial sector got hit and banks got hit with market forces over the week, this is not really suggesting there's any problems right now. Then looking at the advanced decline line, we're holding up. And I have little lines on here because I'm doing this as part of a weekly newsletter. We're still above the moving average based on price, and we're coming right down to the moving average based on volume. Now, this suggests more rotation, and we were seeing this on the daily chart as well. And both the red lines, the moving averages, are still going up. Now, if we fall below these red lines, yeah, we're going to turn more negative. That would mean that money's coming out of the market instead of going from growth areas to value areas, which has been holding up these lines a little bit better. Now, we saw a real advance, and most of this came on Friday. We just set a massive amount of new lows. And so that's turning our 4-week and 10-week moving averages down. And that's more internally negative. Where this had been holding up quite well prior to Friday, Thursday and Friday, but mainly on Friday, when we saw this really just fall off a cliff. But that had to do more with rotation. Now we're seeing some money coming out of the market, and that's when we want to see, okay, was that a capitulation on Friday and we're going to bounce up from here? Or are we just getting started with more of a decline? We're also below the midpoint with the advanced decline ratio, both 19-week and 39-week. As far as our trend, now on the daily side, we're negative and looking extreme negative on the short-term and intermediate-term chart. We're above 20 here. That's a confirmed trend above the moving average. That's a strengthening trend. And look at where the red line is. It's not quite up to 40, but if it gets up there, This could be an extreme negative reading here. And we're also negative, but below the midpoint with the Arun. That just shows there's more sellers than buyers. The mass index is not generating a signal, but we are seeing a signal generated, which would be a buy signal on the daily chart. We just don't have any confirmation of that yet, that it's actually happening. Here's the daily chart where it just looks like we're falling off a cliff here with a massive increase in volume, which could be capitulation. That's usually what you see at times like this. The 50 period moving average, that's 50 weeks. First time in quite a while we've actually fallen below that with the S&P. The long-term trend, we're still in a positive trend here. The blue line's above the red line. This is a 13-week moving average above a 50-week moving average. And we're watching this on the daily side too. If we cross below it on the daily side, that would turn the long-term trend to negative. If this drops below, that would confirm the long-term trend as being negative as well. And these are the pivot points, and we know these before it even happens. We were really holding on to this pivot point here holding, and it did for quite a while, for a number of weeks. We fell down. Pretty much all this came down on Friday. But notice we came right down to this S1 pivot point. That's why I post these things on the YouTube community tab. See how the market uses these things. And that's really where we set the low, but we also closed right at that level. Now, we're also coming down to the midpoint of the trend channel. This goes back to 2009. And when we started to slow down in December and into early 2025, we hit the upper end of this trend channel. We did set a new all-time high. That was in the middle of February. But since then, we've just been coming down. This could be a support level. Now, we found down below before, but there's other times when this actually provided support back in 2016. So we'll have to see. We're seeing a real convergence of possible longer term support levels right now. The market just may blow through them and keep going down because they blew through other ones that we were watching above current price. But that didn't seem to matter. We need this to work its way out before some buyers are willing to come back in. We don't know if that'll happen on Monday or if it'll even happen this week. We're turning more negative here with accumulation distribution. For the first time in quite a while, since late 2023, we're falling below the moving average. And that's meaning the smart money is net selling right now. And that's longer term negative. We're also going down with the Chaikin money flow, which is negative, and we're going down with the vortex because the red line's going up as the green line's going down. The Chaikin oscillator is below the midpoint and declining. That's negative. We're below the midpoint and declining with the McClellan oscillator. A little bit above with the summation index based on price, but we're a little bit below based on volume. And this could be holding up a little bit better because of the rotation. Instead of money coming out of the market, it's going from one area, growth, into another area, value. And we're a little bit above the midpoint here based on price with the Swinland trading oscillator, a little bit below based on volume. And the momentum, which never did really turn positive, it's been rolling over with the PMO. We're right around the midpoint based on price and right below the midpoint based on volume. Starting to get extreme with the PMOs that are rising. This means that we're going down pretty far, pretty fast. Almost getting extreme negative with the buy signals, and we're declining with the PMOs above zero. And we're extreme negative now with the bullish percent index, and we're seeing the same thing on the daily chart. But this could still go lower than where it's at right now. This is where we're seeing something interesting. We closed down below the lower Bollinger Band as measured by the percent B indicator. We also did that on the daily chart, and we don't see those happen very often at the same time, both a daily chart and a weekly chart together. That could be positive because these tend to not happen very often, and when they do, it tends to be rather significant, especially when we're seeing a confirmation between the daily and weekly charts. Momentum still going down, short, intermediate, and long term. Negative across the board there. Another momentum oscillator, the Copic curve is negative. We're way negative here with the force index. And we're below 50 and not quite extreme with the money flow. We're extreme, showing negative momentum with the Stochh RSI, and the Williams percent R is also extreme negative. The ultimate oscillator, not quite extreme, but negative. The relative strength index based on 14 weeks, starting to get extreme negative after being above 50 for all of 2024. Rate of change, we had a massive down week, so that's looking pretty negative there. We're declining here with our 50-week rate of change as well, but we're still slightly above the midpoint. We're still positive with the weekly special K chart, where we've been negative for quite some time on the daily special K chart. And I redrew these a little bit because this is a Fibonacci retracement study here. This was where we set the low in October 2022. This is where we set the all-time high in February. We've retraced more than 38.2%. We blew through that. So this support level has not held. Are we going to go all the way down to the 50%? Now you notice this green line here? That is the line in the sand between ultimate positive and negative. That's a 200 week moving average, not 200 day, not a 50 week, a 200 week moving average. And when we were coming down in 2022, this is where the market made a stand. So, and it was able to bounce up from that. Now, we're not there yet, but we just want to keep an eye on this. Then we are negative when we look at the Heikin-Ashi chart. We're negative with the Kagi chart, negative with the Renko chart, negative with the three-line break chart. And lots of O's being drawn in here with the point and figure chart. Lots of O's being drawn in on the daily side as well. Below zero and declining with our 14-week ease of movement. That tries to measure the path of least resistance. Momentum is clearly down in the long term. We're negative in the intermediate term, and we're negative, quite negative in the short term. You can see we're getting really extreme negative readings, which may entice some buyers to come in soon. All right, then we are negative with the Elder's Impulse system here for the S&P, and we're negative on the daily chart and negative here on the weekly chart with the parabolic SAR since the dots are on top. We're negative in the short and intermediate term with all the different stock indexes, where mid caps and small caps are negative long term. And bonds are positive in the short and intermediate term. Commodities are getting hit a little bit. This is what was causing some inflationary concerns. Look at commodities are going up. Well, they got hit with everything else this past week, and the dollar's still weak in the short and intermediate term. And this just shows the S&P with its decline, the mid caps and the small caps, which are quite a bit weaker right now. The Dow is still in a longer term uptrend, but fell way below its 50-week moving average. You're going to see a lot of the same thing here. NASDAQ weekly chart below its 50-week moving average. NASDAQ 100 also. Mid caps showing a death cross here, and we're seeing a negative trend on the daily side, and now it's being confirmed here on the weekly side. Small caps also daily, weekly downtrend here, and really weak right now. This is a daily chart of the Wilshire where it continues to fall further below its 200-day moving average. The NYC, which had actually been holding up better, it got hit as well, but it's still in a longer-term uptrend. The FANG index dropping further below its 50-week moving average. All stocks, which are U.S. and world stocks, it's getting hit too. ARC just really having a difficult time. Still in an uptrend, but it was down 13.88%, and most of that probably came on Thursday and Friday. Banks, we want to keep an eye on this. They got hit too. They're starting to get extreme negative longer term with the RSI, but the momentum is coming down, but we're just starting to cross below the midpoint with the MACD. Now, if you thought March was bad, April, the last 5 years, has not been very good either. It's only been up 40% of the time with a negative 3.2% return going back to 2021. And looking at the Dow, seeing some weakness here. The transport's really weak right now, where the utilities have been holding up a little bit better. And here's commodities. They got smacked. They came all the way down to their 50-week moving average, but they're still in an uptrend. Oil fell all the way down to the low 60s after being in the 70s to upper 60s there for a while. The dollar's getting ready to show a longer-term death cross here. It just stays below their moving averages. It got down into the 101 range, and it did bounce back up. It's almost back into the 103 range. Gold coming off of a recent all-time high. That's where people go when things are freaking out. And then this, copper. Now, it got hit. It was down 14% this week, but it's still in an uptrend. And the statement that I say here is if the economy was getting ready to fall apart, copper would not be in an uptrend. It would be in a downtrend. It tends to foretell what the economy is going to be like into the future. And even though it got hit with everything else, it's still looking okay for right now, but we'll keep an eye on this. Silver coming off of a recent, well, not an all-time high, but it got smacked too. It was down 12.65%. Okay, then, but bonds are looking pretty good based on price. This is the total bond ETF, but we're really coming down here with the monthly chart of the stock to bond ratio. This is a daily chart of rates coming down at different maturities. This is a weekly chart. I was concerned about this red line, the 10-year in Japan. Nobody seems to care about that. They're freaking out anyway. And then some relative studies here. We have gold performing the best with the bonds based on price in second place. And then the dollar's in third place. Oil really dropped down. And then stocks are the least, they're the worst performing assets so far year to date. We look at the NASDAQ 100 to S&P ratio. This is going down. That means growth is underperforming value because S&P has value in it and growth, where the NDX is just growth. The S&P 100 still in an uptrend longer term with the S&P 500, but it's showing a lot of weakness. Growth to value ratios are declining. Gold has been going up as the S&P has been going down. So this ratio has really been shooting up. And the dollar's been going down as gold's been going up. So we're also seeing this ratio going up. And bonds are starting to outperform stocks here longer term, where we have seen just the opposite over the last few years. I'm going to have to pause this. I apologize for that. Usually, when I record these videos, which I do them all in take one, I don't do any editing. I just start blabbing. That's why I trip over my words and make mistakes and so forth. It would take me many hours to edit this, so I just go with what happens, and I usually anticipate not being disturbed, but it kind of happens sometimes. So we look at discretionary to staples. This is growth versus value here, and it's really been coming down lately. Then we also look at energy, which is starting to outperform. Now, energy got really hit this week, but tech got hit too. And so we're seeing this ratio starting to really turn up. And that could be more negative if this continues. Low volatility stocks, toilet paper, toothpaste, starting to really outperform the tech sector and seeing a recent golden cross here. Small caps, which have been getting hammered, tech, which has been getting hammered. So this ratio is just chopping along sideways. And we look at some long-term types of ways of analyzing the trend. Nothing really that we're seeing here with the NYSE breadth thrust. No new signals with the swag NYSE breadth thrust. Long term, we're coming down to this line going back to the 1987 crash. That could be negative. This is a further blow up. We actually dropped down below this line for the first time since about early 2024, where we went above it. This is showing some longer term deterioration in the charts. But we're still with a full-on Zohorchak method buy signal. Now, there's a one-day lag with this chart. This doesn't take Friday into account. This only goes back to Thursday. We'll see if there's any adjustment in this after Monday's close. Then we're showing some weakness here with the 50-week moving average of, 50-day moving average of the new highs, new lows for the S&P, but it's still slightly above zero. We're actually dropping below zero when we look at that same measure with the NYSE, new highs minus the new lows. And we're dropping further below this trend line with the NASDAQ weekly chart going back to 2009. And then this is actually positive. Now, the NASDAQ 100, the NDX, it's been getting hammered. The Dow's been getting hammered, but this ratio is holding up fairly well. The other time that we went up here was this is the dot-com boom and then the dot-com bust, and then it took us many years to get back up here. This is 2021. We topped out there and then went into a bear market. This is holding up for right now. So this is giving us a little bit of hope. We're also seeing some hope here. This is, again, the NASDAQ 100 and small caps. And they're both getting hit, but small caps are getting hit even more, which is keeping this ratio kind of high right now. And we're just going sideways with the 3-month yield. So we're not really seeing any problems there. We're still seeing some more weakness here with the NASDAQ new highs minus the new lows that's measured on a cumulative basis. That's a little bit different. Seasonality, well, April's supposed to be good. It's positive 73% of the time, up 1.6%. But March was supposed to be that way, and it wasn't. And then November through April, that's the best 6 months where we usually see a return of 7.1%, and we're up 77% of the time. This might be that 23% of the time when we're not. We'll have to see. Okay, and then we have the first half of April tends to perform a little bit better than the second half of April, going back to 1950. And then April, whether you go back to 1950, the past 20 years, the past 10 years, post-election year, it tends to all be positive. But tell that to Thursday and Friday. So thank you. I hope you found this helpful. Please have a really good weekend, and I will talk to you in the next video.